All right, then, econ friends, welcome back. Up until now, in macro theory, macro economics discussions, we've talked about the business cycle, those up and down fluctuations. And then we moved into the stabilization policies, the ways that the government can attempt to kind of soften that business cycle, smooth it out. Last time we talked about monetary policy. And as you recall, that was the use of the money supply and changes in the money supply to in turn influence interest rates, to in turn stimulate or dampen economic behavior. In this set of videos, we're moving from monetary policy into our other type of stabilization policy, and that's called fiscal policy. Let's jump into it. So by definition, fiscal policy refers to the discretionary, that is the deliberate use of government spending and or taxation to influence employment and inflation. So again, the two primary tools of fiscal policy are government spending and tax rates, which are determined by the government through the legislative process. Okay, so again, fiscal policy, government spending, tax policy. It's important to understand as well that when we talk about fiscal policy, while state and local governments both tax and spend, when we talk about fiscal policy, we're generally referring strictly to the actions of the federal government. So our discussions of fiscal policy, they're going to omit or not even really factor in state level government and local. That could be county or even city. We're talking big US level federal government actions. Another thing in terms of just jargon, when we talk about fiscal policy and economics, we make a distinction between discretionary policies and what can be called automatic or automatic stabilizer policies. Quickly, just to address those, automatic stabilizers, those refer to changes in taxes and spending. So it's still a form of fiscal policy. But the automatic stabilizers, those changes in taxes and government spending, those occur automatically. And that's the key, as the name suggests. Those occur automatically as a natural result of changes in the business cycle. Critically, you need to understand that when it comes to the automatic stabilizers, they're going to occur without any kind of deliberate action or legislative action or law passing or budget passing by political actors. So as an example of an automatic stabilizer, suppose the economy has a recession. Well, during a recession, as you know from the business cycle, there's going to be more unemployment. In our country right now, during a recession, this unemployment spending, so the spending on unemployment benefits that out of work people can apply for and get, this unemployment spending, it's going to increase automatically. We don't have to have any, type of federal legislation. Unemployment occurs, people are going to file, they're going to automatically get those benefits if they qualify. And therefore, you're not going to have any kind of deliberative legislative action. So during a recession, we're going to see unemployment spending go up. We're also going to see federal spending on other social insurance programs rise. At the same time, we're going to see tax revenues fall across the country because during a recession, both household and corporate incomes will fall. And because taxes are based on income levels during a recession, as income falls, taxes will fall. So note that there is already stuff going on that's just going to happen automatically as a consequence of the economy. On the other hand, when we're talking about discretionary fiscal policy, and that's really the focus when people traditionally discuss fiscal policy. Discretionary fiscal policy refers to government spending that has to be authorized every year by Congress. So discretionary spending, it's authorized every year by Congress as a part of the annual budget. So basically every year, Congress has to pass as a law the nation's budget. And that budget planning process is pretty long and it's pretty intense. The discretionary spending that we're talking about when we deal with fiscal policy, that's going to be the type of spending that is written into every year's budget. And therefore, it's a part of federal legislation. But the critical part is it's not automatic. It has to be debated out, argued out, negotiated out as a part of the political process. And then once it's authorized by government, by Congress, as a part of the annual budget, then it kicks in. Notice also that because it is an annual budget process, this discretionary stuff has to happen every year. Okay, so that's the broad background of it and the different types. Now, much like fiscal policy, much like monetary policy, as we discussed before, fiscal policies can be either expansionary or contractionary. So this can be a tool in theory that can be used to open up or kind of contract down, expand or kind of dampen down the economy. Let's talk first about expansionary fiscal policy. So expansionary fiscal policy, which is also known as fiscal stimulus, this effectively is an increase in government spending and or a decrease in taxes, with the general goal being to increase aggregate demand and therefore to increase employment. So again, the expansionary fiscal policy is going to be trying to open up the economy to increase AD and as a result, generate increased employment. It's a way to fight unemployment and therefore will be used in a recessionary period in theory. Again, expansionary policies will be increases in spending or decreases in taxes. To understand how this is going to work, it's best to focus on our old formula. We've seen it time and again that GDP or aggregate demand is going to be equal to C plus I plus G plus X minus M. Expansionary policies work by either directly increasing G. So if the government decides to spend more money to increase spending, that's G. That's the government spending. So expansionary fiscal policy will just directly raise that. Pretty straightforward. Or it can work indirectly, and that's where the tax changes come in. You can imagine that if Congress lowers taxes, and you think about taxes as incentives for economic activity, lowering taxes is going to encourage consumption and investment. And therefore, indirectly, we'll see expansionary policies raise C and I. Note that both of those tools, the tax lever to increase C and I indirectly or government spending to raise G directly, they're both going to have the impact of increasing economic activity. Now, on the other hand, we have contractionary fiscal policy. And this would refer to one of two different things again, okay? Two different mechanisms to manifest a contractionary policy. Number one, we can see a contractionary fiscal policy as a direct decrease in government spending, or we can see it as an increase in taxes. So the two tools is our second type, contractionary policy. The two tools of contractionary policy would be to decrease G, decrease government spending, or increase taxes, which would play out by pushing C and I down. The key to understanding contractionary fiscal policy is that it is directed at decreasing aggregate demand and would typically be used to sort of tame or bring down inflation. And once again, just like you did before with monetary policy, you can start now seeing when in the business cycle it's appropriate to use one tool or the other. Always thinking about smoothing out that business cycle, getting rid of that volatility like we discussed, okay? Now, contractionary policy, you get the idea. The reality though, while theoretically you can do contractionary fiscal policy by decreasing G or increasing taxes, in practice, Contractionary fiscal policies are rare. They rarely are passed. And the reason has to do more with political incentives than with economic necessities. Think about contractionary fiscal policy. Cut spending, increase taxes. Both of those, you can imagine, would be extremely unpopular with voters. Nobody wants to pay more tax, and nobody who receives a form of benefit wants that benefit pulled away. So most people would reject politically and in the ballot process contractionary policies. And again, you can see this from the lens of economics. Politicians who craft those fiscal policies, they have no incentive. Back to economic thinking, back to the idea of incentives and opportunity costs. Contractionary policies are going to be rare because politicians who craft fiscal policy, our Congress, they have no incentive to raise taxes. Because if you think about it, a tax would impose a visible cost on voters. So there is no way that politicians, if they want to get reelected, are going to over and over again raise taxes because voters see that as a visible cost. They also would never want to cut benefits because voters would dislike that as well. This is a really quick little segue just for your knowledge and your jargon knowledge. There's a great branch of economics that's known as public choice analysis. And what public choice analysis does, it's an area of economics, and it applies economic principles to political science topics. And this has become a really popular field in economics, especially in our country, because increasingly we can see the motivations of politicians as rooted in economic theory. The idea of incentives, the idea of opportunity costs, the ideas of information that we've discussed, all of those ways of economic thinking can all be applied to the political sphere. And it lends to a really rich understanding of the motivations of politicians and even to the overall functioning, even to the overall structural functioning of political groups and political offices and bureaucracies. Okay, so we call that public choice analysis, just so that you know it's a way to look at poli-sci and politics with the economics lens attached, just so you know. Now, you know, therefore, or you know now, that fiscal policy is government spending and tax rates, that it can be expansionary or contractionary. To complete this discussion, though, it's important that we go back to a concept that we visited in monetary policy, and that is the multiplier. Because there is also going to be a multiplier effect in fiscal policy. Okay, the multiplier effect, which is also known by the term the fiscal multiplier, or the jargony way, just the multiplier. This refers to the multiple by which a direct change in fiscal policy, meaning a direct change in G or in taxes. Okay, so the multiplier refers to the multiple by which a direct change in fiscal policy will affect overall total aggregate spending. Okay, the multiplier effect goes back to a concept that we've discussed before, and it builds on the idea that one person's expenditure has to become another person's income. Okay, it's really important, kind of counterintuitive, so we'll say it again. In any economic system, one person's individual spending has to lead to somebody else's economic income. Let's do an example real quick, real simple one. Let's suppose, for example, that the federal government authorizes $10 billion of spending on military aircraft carriers. It can be any product. So we're going to see this G of $10 billion, okay? A direct increase in government spending to finance the production of military aircraft carriers. Now let's play this thing out. Note that this $10 billion of spending, which is a direct increase in G, has to also become $10 billion of income to the companies that actually build the carriers. And when those companies get that income, they're going to pay it out to all their workers, all the designers, workers, line manufacturers, subcontractors, all those thousands, maybe tens of thousands of workers who make an aircraft carrier possible. They're going to get paid, obviously. Well, think about this. When those workers get paid, they're then going to go out and spend it. And that's going to raise C because their spending is consumption. So the military spends 10 billion on these carriers. It pays the contractors. They pay their workers. Those workers get that income. They spend it. That's going to increase consumption. But note that when those workers go out and spend that money, their consumption becomes income for others. At all the different stores and locations where those workers spend their money, that spending becomes income to others. And then those others go out and they spend their money, and that becomes income for someone else. As this process goes through successive rounds, what we're going to find is that the overall total income will expand by a multiple, by a multiple of the initial spending, okay? So the multiplier is going to be a very important way to understand fiscal policy. To understand the multiplier, we have to kind of dig down to a couple of other concepts. These are a little bit technical, so we'll go through them really quick and we can practice them in class. The first big concept to understand is what's known as the marginal propensity to consume. The marginal propensity to consume, also called the MPC. Don't get overly thrown by this term. You know the jargon and you know what terms mean. So the marginal propensity to consume, that's going to refer to the proportion of any additional income that a household earns that it chooses to spend on consumption as opposed to save. So for every dollar or every $100 or every $1,000 that a household receives as income, how much of that will be spent on consumption of goods and services as opposed to saving it, not spending it? That's the MPC. The MPC, therefore, is simply calculated as additional consumption, marginal consumption, divided by additional income. Once you have that number, you can calculate the multiplier, because all the multiplier is equal to is 1 divided by 1 minus the MPC. So if you're given the MPC or the data to calculate the MPC, you can insert that into this formula here, and you can calculate a multiplier. That multiplier, again, will be the multiple by which any direct fiscal policy will amplify, multiply, fully expand throughout the economy. Now, in econ, for simplicity, we typically just use one single number as the multiplier in our models and our case studies and in our problem solving. But in the real world, it's important to know that the multiplier is not a single number, but rather there's different multipliers for different types of consumption in different circumstances. Multipliers in the real world, they sort of depend on specific economic circumstances. And right here, just for some comparison, so you can kind of get a sense of it, I give you different estimates of multipliers for different kinds of fiscal stimulus. So down this column here, we have the different kinds of fiscal stimulus. And then here we have estimates of the multiplier on the low end and the high end based on economic research. And you can see that for federal spending on goods and services versus transfers, you get the idea, there's going to be a bit of a range. So again, for simplicity, we're just going to use one multiplier in our examples in class. But in the real world, different types of fiscal stimulus, different economic conditions will produce different multipliers, and not just different multipliers, but typically ranges of those multipliers. This is one of those things that sort of complicates fiscal policy in the real world, because it's not so simple to just know, oh, $1 million of government spending will do this. Instead, there's a range, and those ranges aren't perfect. Okay, so now you know what fiscal policy is, you know expansionary, you know contractionary, and you have a sense of the multiplier. Thanks, my friends, and I'll see you next time.